Good morning, everybody. Good morning, ladies and gentlemen, and welcome to this webinar AFME and Business Europe have organized together on financing the recovery, the role of financial markets in rebuilding the European economy. My name is Markus Beirer. For those who don't know me, I'm the Director General of Business Europe, and it's really a pleasure to welcome you all to today's event. And I'm delighted that we'll be discussing this very important topic today. It's extremely important, and the challenges we are facing are formidable, of course, and we all know where we are. After the deepest recession since the Great Depression in the 20s, 30s, we have somewhat recovered over the summer, but the path back to the pre-COVID level is likely to be long and uneven, and uncertainty remains high. The second wave, and of course the third wave and subsequent lockdowns, continues to cause severe difficulties for many businesses, in particular, of course, in hospitality and tourism sectors, but also for many others. And the recent months have certainly been very testing for European business. There is bad news and there's good news. Unfortunately, recently, the balance was not totally where we would like it to see, but there is good news. On the positive side, we have seen that manufacturing was holding it up and performed relatively strong. And like in the last crisis, for different reasons, we've seen that when you have a strong performing manufacturing sector, you are better off. This has also been boosted, of course, by growing export demand from the United States and China. And also on the positive, we see that many businesses, compared to the first lockdown, are better prepared and can adapt better to the lockdowns, which of course somewhat mitigates the impact. On the negative side, business confidence remains low, and this means it's unlikely that business investment will pick up somewhat soon, and we all know we will need this to fully recover. This means we will need to reconsider our priorities, we will need to protect our competitiveness, we will need to prepare for future similar shocks, and of course we'll also need to seize new opportunities. But more than ever, we need to make sure that until we have overcome this crisis, we ensure that viable businesses and jobs are protected and the scarring of the economy is not deeper than it must be. And there is a risk remaining that the too sharp withdrawal and too early withdrawal of support measures for business could undo the work we've done over the last 12 months, keeping viable businesses alive, keeping viable jobs existing. Of course, and let me also be clear about this, we will not be able to stay in crisis mode forever. I mean, this is very clear. But now we still face a situation where getting out of the support measures too early would be a problem. And in particular, if I look at the 350 billions of loans to companies that are subject to debt moratoria, or the almost 300 extra billions of loans subject to public guarantees. So a sudden withdrawal of these possibilities would bring the danger of a damaging cliff edge. We must, before everything, keep investment levels at a decent level. And of course, as private investment has plummeted, the EU Recovery and Resilience Facility is a once-in-a-lifetime opportunity to bring it back, but also to transform our economies, boosting productivity, growth, and competitiveness. And we must urgently make sure that the national plans to deliver will deliver what we need, investment and growth enhancing reforms. And from what we hear from the member states, there's still a lot of work to do. But we also need more private investment to ensure that companies can access, and we need to, in order to facilitate this, we need to ensure that companies can access the finance they need. Access to finance, and specifically long-term debt financing and equity investment, is a precondition for companies to thrive, to make the investment necessary to drive growth, to maintain competitiveness, and to provide jobs and prosperity to citizens. All these issues will be discussed today, and I'm very pleased that we have an impressive lineup of speakers and panelists, which will be introduced when the panels start. And I also wanted to really thank our colleagues from AFME for organizing this webinar with us. During the next 2 hours, we'll be covering two main topics in two different panels. One on the performance of European banking and capital markets during the pandemic. The other one on the road to the recovery, policies to ensure access to finance and well-functioning banking and capital markets. But before we go to the panels, I'm very pleased that we have Member of European Parliament Isabel Benjumea joining us today and being our keynote speaker, as she's the Vice Chair of the Committee of Regional Development and a very active member of the Committee on Economic and Financial Affairs, the ECON. And we are very pleased that you're with us today, Isabel. And without further ado, the floor is yours, and we are looking forward to your keynote speech. Please.
Thank you. Thank you very much, Marcus, for your kind introduction, and thank you very much to AFME and Business Europe for inviting me for being here today. We are here to discuss about the financing the recovery, the role of financial markets in rebuilding the European economy. In this sense, I wanted to share with you a few ideas that I hope that they are useful for the further discussion in the panels. First, I would like to focus on something that you've just mentioned, Marcus, that we are living unprecedented times. The COVID-19 crisis continues to have a major disruptive impact on the economic and financial stability of the European Union. This crisis is increasing some vulnerabilities in the financial sector, such as public and private debt accumulation, increasing prospective credit losses, and weaker profitability in the banking sector, and greater risk-taking in the non-bank financial sector. In this sense, the European Union needs to take steps to support the recovery and further develop and integrate our financial markets, also relieving public finances, helping banks in their profitability issues, and boosting the financial system resilience. This is not the first financial crisis that we are facing. So we do have some lessons learned from the past. In the last economic crisis of 2008, the weight of the economic recovery fell almost entirely on the banks. This led to a weakening of the European banking system, which, although very strong, could not bear the full weight of this responsibility. The economic consequences of these decisions have remained with us until a new crisis has struck Europe. In Europe, banks play an essential role in stabilizing the economy, reviving it, and in the EU international role. However, in order to make the European Union's economic framework even stronger and more united, is it essential that other market players be strengthened and that action be taken to relieve the banks of their role in the European economy. The way out of this crisis cannot be supported by banks alone. Is it essential that other alternatives be strengthened in Europe to help states, companies, households to emerge from this crisis? Therefore, diversification of financing alternatives is essential for the recovery. We can not only rely on the public financing because it's not enough. This is another important idea I wanted to share with you. The recapitalization of companies plays a key role in the financing of the EU's economic and social recovery. SMEs are the economic driver of the European countries. They are the only ones capable of generating employment and helping European households and countries to emerge from the crisis. However, strengthening the supporting of SMEs should not only come from direct aid from European public funds. I do welcome strongly the EU's major recovery package, the Next Generation EU. Programs such as InvestEU will allocate millions of euros to encourage European companies to develop innovative projects that will enable them to grow. The RRF will also be a great capital injection support for our economies. or even the Pan-European Guarantee Fund, which foresees almost 25 billion euros for direct aid to SME debt, quasi-equity or guarantees. But I truly believe this is not enough. I believe that the focus should also be on private investment, as Markus also said on his remarks. So we need to also on private investments, and we need to create the framework that will allow those private investments to be injected into the EU economy easily. I will develop it further further on when I talk about the Capital Markets Union, but I want to acknowledge that capital markets are an essential instrument to achieve this objective, and they can play a key role in the recovery. Well-functioning European capital markets, by making them more integrated, will allow capital markets to assume greater responsibility for the recapitalization of the European companies and households. In this sense, national banks and central banks could assume other burdens and responsibilities also needed for the economic recovery. The ECB and the national central banks have a very important role to play, but we cannot afford to think that they alone will lead us out of this crisis. The ECB's efforts to inject capital into the European markets are certainly a great help for the recovery, but we should not rely on these monetary policies as the only option. I had the honor to be the rapporteur of the CMU report in the European Parliament, and from the very beginning, I've claimed that the CMU is a key tool for refinancing the EU economy. The EU has been trying to strengthen and unite the markets since 2015, when the Commission launched its first action plan. Today, 5 years later, the European Capital Markets Union has proven to be an essential priority in the face of present economic and social situation we are living through the EU and globally. The COVID crisis has shown that it is essential for the European markets to be more united, and that the way out and that the way of the economic recovery has to come hand in hand with an increase of investment options in the European companies and households. Refinancing the European economy will go along with a lively revival by the markets players. Cross-border investments needs to return. The EU needs to be able to attract foreign capital to invest in our companies and our startups, and those are essential for the recovery. We need to get rid of the barriers posed by the SMEs accessing finance, and we need to attract more retail investments into the European capital markets. A more developed CMU is key to funding the post-COVID recovery, as private funding from the capital markets will complement bank funding. We cannot have our SMEs relying on the bank lending as their only financing option. The Capital Markets Union facilitates access to financing capital for business, and this is of greater need. It will revitalize the flow of capital within the EU and will reactivate the cross-border relations on the financial system in order to make a stronger and more united Europe, which is essential in this crisis that we are facing. The CMU would also improve and diversify funding conditions, creating jobs and growth. Citizens and companies will have access to a broader range of investment portfolios, helping to improve return risk trade-offs in their savings and investments. The achievements of the Capital Markets Union would make the European markets stronger and more united, which would promote the role in the international market, as deep and liquid domestic financial markets are fundamental to currencies' availability to attain and extend this international status, especially since the Brexit. The EU could become a more competitive and attractive market in which international companies and investors want to operate. Therefore, the Capital Markets Union, in my opinion, needs to be developed as a priority for the recovery of the EU economic. In conclusion, I wanted to share just two ideas. To focus The focus must be on increasing the access of European companies to finance and building a more resilient economy, preserving and creating employment and productive capacity of the states of the Union. Recovery must go together with the strengthening of the European business fabric and the recapitalization of SMEs. And finally, the culmination of the CMU goes hand in hand with the deepening of the economic and monetary union, and in particular, the completion of the banking union. We cannot try to achieve one without the other. They are interdependent. In this way, the CMU is a good tool to decrease the weight of bank lending in the recovery and to alleviate the debt bias of the EU. I wish the best for these panels that will come now. I look forward to follow the discussions, and I want to thank again for this invitation, and I hand it back to you, Marcus. Thank you.
Thank you very much, Isabel. Thank you, MEP Benjumea, for being with us and for sharing your insights with you. And I think this was a great intervention to start our debate. You've mentioned very important points. I mean, monetary policy is key, but of course it cannot make the trick alone. This is why we'll need the RRPs to deliver on investment, but also on structural reforms. But you're also absolutely right. We, of course, need private investments. And in order to do so, we need access to finance. For this, we need our banks to be strong. We need to be careful with things like the implementation of Basel 3.5. So this needs to be recalibrated, but we also need a diversification of financial alternatives. So I think you covered a lot of ground, Isabel. Thank you very much again. And I would now like to introduce my colleague and Chief Economist, James Watson, the Director of Business Europe Economic Department, who will be moderating the next session of today.
Thank you very much, Marcus. Thank you very much, everybody. Good morning. As Marcus said, I'm James Watson. I'm the Chief Economist at Business Europe. I'm going to moderate this first session, which I think is really about thinking about how the financial system coped during what's been the last 12 months now in terms of delivering credit to the real economy. I'm delighted to say I think we've got a very good panel. I think it spans both the banking side, the official side with the supervisor, and the real economy. I'll very briefly introduce the participants. So Eduardo Fernandez Polo is going to kick off. He's been a member of the ECB Supervisory Board since September 2019, and prior to that, he had a long and distinguished career both at the French Central Bank and at the French Banking Supervisor. Then we'll have Eric Nielsen, who's I think very well known as Chief Economist at UniCredit. Prior to that, he worked at Goldman Sachs, the IMF, and the World Bank. And then Klaus Deutsch, who's Head of Research, Industry and Economy at BDI, the German Federation of Industry. And he's also chair, I should say, of Business Europe's Affairs Committee. Prior to BDI, he worked at Deutsche Bank as well. And then finally, last but not least, we'll hear from Michael Lever, who's Head of Prudential Regulation at AFME. Michael has also had a long career in various banks, and he started his career at the Bank of England. So I think we cover a lot of bases with that panel. As I say, Eduardo will kick us off in a moment. If you have thoughts or comments or particular questions, I think you're invited to put them in the chat, and we'll try and pick up on those when we get to a second round. But without further ado, I suggest we hand over to Eduardo to give us his opening thoughts. Eduardo.
Well, thank you, James, very much for this opportunity, and larger to Business Europe on AFME, to give me this opportunity to reassert the three more important messages that, as supervisors of the banking union inside the European Union, we want to deliver to the industry and the market and the public as a general on the issues you just raised. The first issue is, how do we assess the performance of the European banking system? And here I think the first message is very clear. In fact, it was, I will say, a proof of resilience that was even more than we expected. In fact, first, the operational resilience. I have to underline that there was a big challenge for the banks to move in the confinement period with all the distance operations, with people not going to work in the workplaces, and there were no disruptions of banking services. That was really one of the first very good results that we could have 1 year ago, indeed, already. But I will say, even in the medium term, and from a purely economic point of view, the economic impact of what has been the biggest shock to the European GDP since the Second World War, you can discuss exactly adjusted, but it is certainly the biggest one. I think GDP will end around 5% lower at the end of 2020 that it was at the end of 2019, and yet, with this very big shock, the financial situations of the banks, when we compare again the end of 2019 and 2020, well, in fact, we expect will be better. We are still aggregating all the numbers, but clearly, for instance, on the solvency ratios, they will be better at the end of 2020. And something for the total capital ratio, something like more of a point. We are going from 18.5 to 19.5 more or less. And even in CET1 ratios, we have also a progression, maybe a bit smaller, of half 50 basis points, but we have a progression, which is something. 1 year ago, I don't think there were many people that would have said that. And we have a progression with an increase of the cost of risk, because the increase, if we see that this year the cost of risk, it will surprise nobody, has increased above 50%, something like that. And we have had something like around 90 billions of provisions. So the banks have absorbed this cost of risk, have absorbed these provisions, and yet they are in a better position at the end of the year. That, of course, comes a bit as a surprise, but it's a surprise that has a reason, and I think everybody knows what is the reason, is that very early, already in March last year, there was an articulated and consistent response by all the authorities, among them ourselves. 1 year ago, we first took supervisory measures for relief, anticipating changes in composition, releasing the buffers, releasing P2G, measures that had an impact. We calculate now that this impact was around 200 billions of increasing the margin capacity of resistance of the banks, so almost doubling it in respect to the minima of requirements of the regulation. That was on the supervisory side, that was done. But of course, one very important and extremely important aspect of this support has been the government support for the economy, which is what has, I will say, broken the correlation between the GDP and the defaults. The GDP has gone very much down, but because of government support, this has not translated in defaults and so in impairment of loans in the way would have been in a normal, I would say normal, of course, into brackets, recession of 5%. So this has protected, in fact, the bank balance sheet. So what are the lessons that we take from that? It is first, of course, that the improved resilience of the banks, when we compare to the crisis 10 years ago, has been a very good thing. Clearly, this has helped the banks operationally and financially to resist the shock. But, of course, the prompt and massive reaction of the authorities have been very instrumental to making the banks in this very difficult year able to continue financing the economy and absorbing the provision. So for the future, we have, therefore, two considerations that are very high in our mind. The first is that, of course, this amount of government support should be very carefully withdrawn. Carefully, that's clear, we all say that at the ECB, but it will end. So we'll have to prepare for the phasing out of this support. And that means that there is an important shock in the economy and in the borrowers that will materialize. We hope to avoid the cliff edge, but we are sure that this will be coming. So it clearly, our first priority, and it is a priority we've set for banking supervision this year, is to monitor very closely the risk management systems of the banks so that they are able to anticipate the effects of this phase out. They are able to manage it from a risk management perspective and to prepare for this slowly unwinding of the government support. That's the first point, which I will say it's a cycle issue, how we get to the next phase. But then also, a second issue that is also very prominent on our mind, it is that we have not to delude ourselves. There have been structural constraints on the banking system, which materialized, for instance, in the very low profitability of the banking system in Europe that are not still there, and even in fact have been aggravated by the crisis. Because if the solvency has withstood the crisis, we cannot say the same for the profitability. It was already very low and in comparison to peers, and it has lowered even more. I would say one can discuss the different reference, but if you take the return on equity, it was not very good, around 6%, and now it will be under 2%. Of course, here again, everybody thinks that in the shifting out, we will come back to something better, but not something really considerably better. It's not even foreseen that in 2023, we will be back at 6%, which was already a low figure for the return of equity of the banks. So here we have really structural constraints that, given also the nature of the response of the crisis, the low for longer scenario, will stay there and constrain the capacities of the banking system. So here the message to the banks, which is very clear, which is also in our priorities for supervision, is you still have to adapt your business model. We all say there will be a transition to a new economy post-crisis. There should be also a transition in the business models of banks. And they should be able to increase their revenues, because clearly there is a lack of sufficient revenue in the banks, and to better be able to reduce the cost, because there has been some reduction of the cost. We see there's a reduction of the cost of banking, but not yet enough to offset these other constraints on profitability. So on the two sides, on the diversification of revenues, as on the lowering of the cost, and we need to adapt to the structural business of system, and this is all the most needed, that we need to adapt it to finance the transition of the economy. We need to finance that. So the two things are together, because trying to prevent too much accumulation of non-performing exposures, we know that it is key to be able to finance the recovery. And finance the recovery means that the financing should enhance the reallocation of labor and capital to the productive firms. We need not to finance the zombie firm. We need to shift the business model of the banks to be able to finance the firms that will really lead the recovery. So again, we have these two messages. We need risk management to be able to reinforce it, to be able to avoid non-performing exposure. And we need a shift in the business models to be able to concentrate on the financing of the real leading sectors for the recovery for the whole of the European Union. So I think this.
Eduardo, thank you very much. I think you've set the scene. I'm going to go straight to Eric. Eric, obviously, from someone in the banking industry, is that a picture you recognise? And do banks need to adapt their business models? Delighted to hear from you.
Thanks for having me. Yes, the short answer is yes to everything I've heard. I greatly enjoyed the keynote speech. I completely agree with the need to develop the capital markets, develop more equity finance in Europe, but of course we need banks for many years to come. We have a retail sector, we have SMEs, and the rest of it in Europe, which is unrealistic to think will all shift to a capital markets model. So we need banks. I share completely also Edward's view of further cutting costs and raising revenues. But I want to put across a word of caution, nevertheless. I'm going to say three things quickly. The first thing is, it is true that banks in this pandemic has been part of the solution rather than part of the problem, like in the big financial crisis, obviously. But I think it is easy to fool ourselves to think that this is all because the banks are healthier today, which we are. Banks are better capital ratios, and all this is important. But make no mistake about it. The reason why the credit has been made possible is due to the guarantees by the government sector. And were they to be withdrawn too early, certainly, then you would see a big squeeze on banks and NPLs and all the rest of it, without a doubt. Yes, the banks have been part of the solution, but the real hero in this has been the governments that provides the fiscal support and the guarantees to make this possible, without a doubt. Point number one. Point number two, I want to elaborate a little bit more on Edward's point of profitability. It's a major issue for the medium term in my assessment. Just to remind you, over the last 10 years, so we are not talking about a year or two or so, over the last 10 years, the European banking system has not a single year been able to generate a return on equity that matches its cost of capital. So how do we think in the medium term that banks can remain well capitalized, let alone get more capital? Because how do we tell the investors that this is a good idea to invest in banks when the return on equity has been lower than cost of capital, which caused banks to trade at only a fraction of book? And we have over these past 10 years also been either the lowest or the second lowest part of the index in terms of return. So you tell the pension funds of the world or Europe and the insurance companies or other investors, come to us and buy or keep your capital in us. And they say, so how has it been the last few years? Well, sorry, the worst. So tell us, how will it be better? And this is a big problem. So let's analyze just in 2 words why this is so. Growth has been very low. That's bad for banks. Every forecast I have seen suggests that Europe will be the last one coming out of the pandemic in terms of GDP levels compared to the America and Asia. So not very good news there. The policy mix has been bad for banks in the sense that over the last many years, it's been too much monetary easing and too little fiscal. Now, in last year, we got a good dose of fiscal, and I applaud again the fiscal authorities. Unfortunately, this year, the European fiscal authorities, while still doing a lot, are planning to do only about 70% of the output gap, too little for me. America is doing 3 times the output gap, to give you a comparison. So the prospect of a steepening curve because of growth, not because of import of higher yields from America, are still here to be. And then very critical cost and revenues. Let me say 2 things on this. Yes, banks have been too cost heavy, will need to still cut cost further. But to illustrate my point, if you were to just cut cost on the staffing side of people, since we're closing down branches and all the rest of it with all the political ramification that comes with this, in order to bring the return on equity back to the average, that would take another 35% cut in staffing cost, in headcount, or firing people, or cutting cost, or whatever, without a single euro drop in revenue. I think this is unrealistic. More cost has to happen, sure. So we have to do more revenues, but make no mistake about this. if banks are going to raise revenues through fees and others, that is an implicit tightening of monetary conditions through the transmission mechanism. It has to happen. But remember, this is a time over the next several years where we do not think that monetary tightening should be hopefully too much, and certainly not until we are back on our feet again. So how do we square that circle? For me, it's not clear. I just don't know. And I am worried that the present situation will have a long time to go in terms of banks getting back on their feet, where they can borrow money in the market and lend it on, as it used to be, and financial intermediation used to be, and not just pick up money at the ECB and hand it on. The last point is that and this is a conclusion, I fear that as the guarantees are rolled off in the next year or two, NPLs will rise because the GDP levels are still too low, and we could easily imagine a credit squeeze develop rather than a credit supportive scenario. I'll leave it like this. Thanks.
Thanks a lot, Eric. Clearly some challenges ahead, which we can pick up on later. I wanted to go to Klaus though now. Klaus, Eric said that banks have been part of the solution over the last 12 months. Is that something from the user side, from the corporate side, that you'd echo? And what do you see as the challenges going forward, maybe?
Yeah, thank you. I certainly agree that banks so far have been part of the solution, but things might become more difficult over the next 1 or 2 years, certainly. I think one has to first state that, of course, the large impact of macroeconomic policies, of direct government fiscal support to companies and workers through the broad schemes we have seen were absolutely essential. Many member states in the EU used also moratoria on tax and on social contributions. Most governments had strong support schemes in place. Several did have counter-cyclical recovery programs in place, and in total fiscal support amounted to almost 4% of GDP last year, a little less this year, and in terms of guarantees, almost 20% of GDP. This is unheard of. This is a super strong fiscal response, even indirect one, that allowed most corporates to survive at all and to avoid to become a liability for the banking system. In addition, we do have the large package that the EU agreed, several packages, both on the the first part on ESM, SURE, and so on, and the EIB, and the second one on the recovery and resilience package, which will help to close the output gap a bit, in particular in those hard-hit countries in the course of 21 and 22. So I think we have an unprecedented fiscal response, and we do have additional action by promotional banks in several countries who stepped in with subsidized lending schemes, both the European Investment Bank itself, but also many national banks. I think in consequence of all that, despite the heavy hit to output, the impact on corporate finance was very unusual and atypical. We did see a strong increase in bank lending to firms and also to households, way above 5% at critical times in the second quarter, of course backed by government guarantees where they were partial or full. During the summer, most corporates were able to get back on their feet, and liquidity was increased a lot, which allowed many firms to get by in the difficult times of the fourth quarter and the first quarter of this year, without having a strong recourse to another round of subsidized lending schemes. So I do see in some sense that the worst was in the last spring and summer, and there was some relaxation in corporate finance since the autumn that has held up so far. Usually we would see in such a huge recession a strong tightening of credit standards. That hasn't happened until very recently, where we see a modest tightening of standards. but financing conditions in general are still very ample. And I think most companies were able to rebuild their balances a bit. Of course, this all goes at a very substantial direct cost to budgets in terms of the direct programs and in terms of implicit costs if guarantees have to be taken. I think for the vast majority of firms, these measures allowed them to survive and to tap bank finance, to tap capital markets going forward, and to finance their activities quite finely. As the pandemic still unfolds, however, substantial support for companies and workers will remain necessary until they are on a sounder footing again. And I think most programs were designed to end roughly right now, because the assumption was that by the second quarter of this year, the pandemic would be under control. Unfortunately, in most European countries, it will probably take until the third or fourth quarter to really achieve that objective with vaccination and all the rest of it. And so I do see that there's still a problem that there might be some need for additional support over the course of that year that was not really factored in. And clearly, there are several sectors such as leisure, travel, tourism, hospitality, and so on that have a large share in GDP in some countries that are essentially closed or so strongly below output that their essential survival is still in question. It may not make such a huge impact on GDP again, but it's, of course, a very serious issue in terms of a medium-term perspective for value added in those countries and for the also for the hit to public budgets. I think that's the key point. I think if you look at capital markets, financing conditions have been very generous after the ECB stepped in spring. And we have only recently seen that the rise in treasury yields and in some European long-term yields are taking place, which would perhaps do a bit of tightening concerning corporate finance in the capital markets. It's not yet serious. Financing conditions are very well, and the ECB is well targeted to look at that. But clearly, there's a bit of risk that we get spillover from the US or through the bond market that would tighten conditions. I think one has also to applaud the ECB not only for Eduard's job, but for the broader monetary policy strategy, because the ECB provided through TLTRO III and through the various purchasing programs a lot of liquidity to financial markets and to the banking system that allowed the banks essentially to tap finance from the ECB at very reasonable and even subsidized costs in order to keep up their lending programs. And I think that was absolutely essential. It avoided panic. It avoided spread widening, and it allowed a very smooth financing of corporates in normal circumstances, not those very hard-hit companies. I think in addition to these regulatory measures, I think that was all very useful. I'm a bit concerned not about monetary policy, which can go on for quite some time with doing these things, but with the potential impact we will get from the finalization of Basel and other regulatory approaches that would essentially ask the European banking system to add a very severe amount of capital to their current system. And Eric spoke about the difficulty of getting that done in an environment in which growth will not be stellar. We expect growth in Europe to be a bit above 4%, but that's clearly far less than the 6.5 or 7 in the US or the 7.5 or 8 to 8.5 in China. And so I think it might even get worse in Europe with the slow speed of the vaccination campaign in the major economies, that the growth outlook will ultimately be much lower, and we have to revise downward and see whether we need another round of fiscal action to close the output gap a bit better. So I'm not super optimistic about the next 6 to 12 months, but I think the policy framework did a very good, both governments and the ECB did a very good job of getting us through 2020. I'm not so sure about 21 yet. Thank you.
Thanks a lot, Klaus. Michael, you've got the most difficult job, I think. You've got we've had a lot of different perspectives. Yeah, we look for some additional thoughts from you.
Thank you very much, and thank you very much for inviting me this morning. I begin by saying that I agree broadly with the comments that have been put forward this morning by the different speakers. Eric mentioned a few minutes ago that the real heroes had been the governments in all of this, in terms of the support that they've given. And I think it's worth providing a little bit of balance to that, and just briefly reminding ourselves what the banks have actually provided by way of assistance during the pandemic. The banks ended 2020 with core equity tier 1 ratios of about 14.5%. These are the European G-SIBs, which is a record level, and that's allowed them to support a record level of borrowing. There was 122 billion of net lending in March last year. That was a 13-year high. And in April and May, that was supplemented by about another 134 billion. The banks have also been able to absorb about 600 billion euros of moratoria. And they've been active in capital markets with 495 billion of debt raised by capital markets, and the banks have been facilitating that, as well as helping substantial underwriting of around 175 billion last year. So the banks have clearly played a full role in assisting the company's survival during this terrible pandemic. On the government side, of course, there's been a sort of a massive 3.7 trillion of bonds issues, and there's been collectively across Europe about 2.7 billion of guaranteed loans. So clearly there has been substantial support on the governments, and that government support, banking support, and regulatory support have combined, as the speakers have suggested, to help us weather the initial impact from the pandemic. Having said that, I just want to say a few words about the prospects, a sort of slightly more forward-looking perspective. I think there are still several uncertainties on the pace and strength of economic recovery. I mean, some relate to coronavirus itself, and as Klaus had just mentioned, the different pace of vaccinations. I mean, sitting here as I do in London, it's easy to forget that the UK has vaccinated around 5 times the level of its population than either France or Germany. And it's easy to forget that France is going into another curfew, and Italy another lockdown. So one needs to think of perspectives from the entirety of Europe, not just from London, when considering where we are in the pandemic. And I think that corporate conditions, again, as Klaus I think has mentioned just now, they do remain weak, and there is a lot of variability across sectors. And I think that there are the uncertainties as to what will happen when government measures of support are withdrawn. We haven't really touched on this, and it's not really for this panel, but there is the question of how to finance the recovery. And comments made earlier in this event have stressed the importance of developing capital markets union for the purposes of trying to help recovery and not place the entire burden on the banking sector. If we actually look at the ECB lending figures, actually net lending turned negative at the end of last year, and there was a net fall in lending of over 14 billion. So all is not that well on the lending front. And again, the ECB surveys show a significant tightening of credit trends, particularly with regard to SME standards. So it's not all plain sailing. And I think even in the event that companies want to borrow more, there is a question of how much more they can afford to borrow. And you'll hear, I think, later this morning from the AFME chair, Michael Colfontaine, about a study that we did in conjunction with PwC, looking at the need to finance the recovery. and the significant gap that exists between the required equity to do that and the available supply. If I were to be a little bit more positive, obviously we've seen the upgrades in both national and global GDP forecasts, and there are tentative signs of a modest recovery in inflation, which actually will help flatten down non-performing loans and will help bank margins. And you've seen that actually reflected in bank share price in the last 3 months, where actually bank share prices have also started to outperform. Often the credit markets are a good leading indicator of what is going on. If we look at what's happened to credit indicators over the last few months, they have actually turned more positive. And if you look at indicators like the spreads between the AAA and BBB debt, that they have been narrowing. Now, not all commentators in the market are that positive in the outlook, and we heard remarks from Andre and Ria mentioning increased signs of credit risk in the last few days. What we do know is that we had a surge in bad debt provisions in the first half of last year and a sharp contraction in the second half of last year, which might be due to so-called IFRS 9 provisioning requirements, which help make provisioning more forward-looking and pulled provisioning into the first half of the year, which is likely to mean we may well see a more rapid decline than previously anticipated. I think throughout the downturn, the ECB has probably been more negative than is likely to turn out to be the case. So the ECB has forecast on a plausible negative scenario about 1.4 trillion of non-performing loans. That's over twice where we are at the moment, and I think the ECB estimates are going to be far too negative. I think with provisions falling likely next year, you are going to see returns on equity increasing, and they will remain, unfortunately, below the cost of capital, and the problems that Eric has alluded to still remain for the banks. But the ECB was forecasting a central scenario for ROE in 2022 of 3%. I would guess that the banks will do at least twice as well as that. So, the ECB, I think, in its outlook has been somewhat more negative, and it does lead to the question as to whether dividends should have been suspended earlier this year. I personally think that was unnecessary and more politically than supervisory justified. So we've heard about the structural problems that still remain. I think one of the solutions not mentioned is further consolidation. That requires progress on banking union, again mentioned this morning. I am unfortunately quite negative on the prospects for that. You have still a huge divergence between countries, with France being much more integrationist than let's say Belgium, that is still pushing hard for retaining existing host country controls. So to conclude, I think there is reason for optimism. I think the banks have played an active role in supporting the recovery so far. They cannot do it all on their own. They are assisting on the capital market side, but more needs to be done there. I think that although coronavirus could still put a spoke in the wheels, I do think the banks will remain well positioned to play their part in the ongoing recovery from the pandemic. I think improving their long-term profitability, unfortunately, is still work in progress. I draw a little bit of hope from the fact that, unlike Eric's comments on the bank's ROEs and cost and equities, that there is examples across Europe and, of course, further afield in the United States where banks are earning more than their cost of equity. So it must be possible. We just need to work out how to do it better. Thank you very much.
Thanks a lot, Michael. We've got about 5 minutes before we wrap up, so we're going to have to be quite quick. So I'm going to go around everybody for some second round of comments, but I say we'll have to be quite quick. I'm going to start with Eduardo to maybe pick up on some of the challenges that have been raised. But in particular, maybe Eduardo, there's been a question in the chat Veronique's raised. She's mentioned this estimate of 1.4 trillion of non-performing loans that the ECB made in June. I know Michael's mentioned non-performing loans. Is that still your central figure, or have you revised that? Is that what you're working around? Interested to hear on that. But as I say, on the broader challenges, I'll start with you, Eduardo. Edward.
Well, thank you. It was never our central figure. It was our negative scenario. The central scenario was not at all on 1.4 trillion. And we've consistently said that for the time being, we are not at all on the most negative scenario. We are much closer to the central scenario, which was a figure much the and we said could be perfectly absorbed by the banks. We are on that. In fact, the NPL at the end of the year will be lower than 4% in Europe. So it has lowered also from 2019, because you've seen that the market for NPLs are still, not at the beginning of the year, but afterwards were still functioning. So again, we are not at all on that. But, and this is, I will really want to underline, these needs also careful management of the exposures on the moratorium, to be able to be sure that when they are withdrawn, you still have a sustainable path.
Okay, great. Who wants to go next, Eric?
Sure. I don't have much to add apart from maybe certainly agree with what Michael said, that and all of you said, that it's when I highlighted the public sector as the heroes, it certainly comes across that way for me because of the enormous change in attitude in Europe to fiscal policy that came about last year, which is very positive. But for sure, the central bank, the ECB, were critical. And I think exactly one of you mentioned the TLTROs, which are really the blood system now. This is where the banks go and borrow money. The problem, and this leads to my fundamental concern medium term, is that we have come to a stage where the banking system in Europe as in general are not functioning really as private sector companies anymore, in the sense that borrowing from the market and then intermediating and lending for investment. No, we can't borrow in the market because our credit rating or our cost of this money is too high compared to our clients. So there is a real problem. Of course, we can go to the ECB. So how we unwind this and put it back to where it used to be. I think the Americans are leading the way by this enormous fiscal package. I'm not advocating that size or the composition per se, but without something more dramatic, I wonder whether we can just sort of squeeze ourselves out of it and get the banking system back to where in a new function, obviously, and a modernized IT related, also lots of money needed. I am a little bit nervous. We will start to need some big consolidation of banks to get efficiency gains to match our clients. That seems also to be a problem. But I can go on for a long time. But it's but obviously it's immensely complex. Thanks.
Yeah, I think there's also in my mind a question of how long the total consensus in the ECB around supporting financing conditions can last, particularly if inflationary pressures pick up. I think that's going to be the story. Maybe in a year's time, but who knows? Klaus, any final thoughts? Do we need a bigger stimulus package in the EU?
We probably may need additional packages at the member state level going forward if the pandemic takes much longer than another 2 or 3 months, and it's likely to be the case. And so we need to figure out, this will probably halve the forecast for economic growth according to the central scenarios by either the Commission or the ECB. And if that's the case, we will be stuck in a pretty bad situation. We might need to do something about that. One final comment would be, we have to worry a bit about those hard-hit sectors that are out of business now for 7-8 months in several countries. And I'm not sure whether insolvency is the sort of mechanism to solve the problem, because we may need those hotels and travel, airlines and travel agencies and what have you afterwards. And so I think we haven't yet gotten into the point where equity schemes and medium-term arrangements involving governments have played a large role, because so far we worked with liquidity schemes and some equity support, but I don't think it will work out that way, and we might have some very nasty discussions. It would be better to have a European framework for that, rather than having member states crying out whether it works out to save the vacationing industry or not. And I think that's still an unsolved issue.
Okay, thanks a lot, Klaus. Michael, you've only just wrapped up. I don't know if you wanted to add any further points.
Just very briefly, it's clear that we need to look for other instruments just beyond those that currently exist to help finance recovery. And one of the areas that we're currently looking at the moment is whether it's going to be possible to both expand existing use of hybrid instruments, but also create potentially a new hybrid instrument, which would allow owners of businesses to retain control while at the same time bringing much needed capital and avoiding excessive further leverage. So I would just mention that we do need to look at alternative solutions just to those that are on the table at the moment, and new hybrids might be one of those solutions. Thank you.
Great. Well, look, thanks a lot to the panel. I think it's been a good panel. We've seen the number of attendees has risen during the panel, so I think that's the key KPI. Just to sum up, I think 2 points. I think Eric said that the governments and have been the heroes of the crisis, but I think we've also heard that the banks have played a pretty positive role as well over the last 12 months. But there's clearly challenges ahead, and we're going to talk, I think, more about those challenges in the second panel. I think we're going to have a short break where the hosts in the UK say you can go for a cup of tea, but whatever you need to do, I think you've got a couple of minutes before we reconvene. Thanks a lot.
Thanks for that.
Yep.
Welcome back, everybody. Hopefully you've been able to get your tea, your coffee, your liquidity, whatever it is you need. Just a huge thank you to our partners for this event, Business Europe, for all their engagement on this really critical issue. And huge congratulations and thank you to our excellent first panel. We've heard about the overwhelming government, financial sector and regulatory support, and the AFME membership is hugely grateful for that. The last panel perfectly teed up this section because they were looking for solutions. And I think it was my colleague, Michael Lever, and the representative for German industry who were looking to the future with next packages. And in this session, as I welcome you back, some of you may know my name is Michael Colfontaine. I have the privilege of chairing AFME, and absolutely thrilled and delighted to lead us through the next session, which is really going to be all about supporting recapitalization of Europe's businesses. We're dealing with three crises, and I think that is clear to everyone. We have a major global health pandemic, but it is particularly acute at the moment in Europe. We have an economic crisis as a consequence of that, and significant support that we've already discussed. That support needs to be repaid, and businesses need to get back on their feet, particularly those social businesses that were highlighted in the closing remarks of our last panel, the airlines, the leisure, the hotels, the entertainment, the travel industry, and we all know how critical tourism is to EU member states. Solutions. The third thing is the climate transition. we're not going to discuss that, but it's critical to getting the right capital structure in even to begin to think about planning for that. As the AFME membership has thought about this, it's clear we need to recapitalize Europe's businesses. And together with PwC, we have published a report that all of you will have or have had access to, many of you will have read. This report, published in January, identified that there's an estimated equity gap of between 450 and 600 billion euros that is needed to prevent widespread business defaults and job losses as COVID measures are gradually withdrawn. And despite these overwhelming government support measures, we know that 10%, perhaps more, of EU companies, particularly the smaller end, have cash buffers to last anywhere between a few weeks and maybe at best 6 months at normal rates of expenditure. And again, as mentioned in the first panel, a lot of the government support and attention has been focused on liquidity. What we need to focus on next is capital. And this report that we commissioned presents insights from interviews with businesses, private sector investors, our AFME membership from across the continent to propose solutions to Europe's emerging funding gap. And the findings reveal that many mid-sized and small and medium-sized enterprises clearly do not wish to give up control. So insolvency, as again we heard in the last panel, is not the ideal solution. And indeed, these private sector owners, company owners, are willing to pay a premium, perhaps up to 8 to 10%, to not dilute their voting rights, and as well are willing to distribute a share of their profits to investors. And hybrid instruments are therefore likely to be very well suited to address these needs. And our specific report recommendations are exploring the development of new EU-wide hybrid instruments designed specifically for the corporate sector and for SMEs. This could be in the form of a new preferred share instrument, which is state aid compliant, to build scale and liquidity, which could be developed to comply with social investment objectives and to attract maximum investor interest. And what we're recommending is replicating existing member state best practice on hybrid instruments and raising awareness of a range of capital markets instruments available for the corporate sector, particularly mid-caps and the small companies. And further exploring the use of innovative instruments, whether these are dual class shares with different voting rights, to address the control concerns of the companies, and perhaps also exploring debt for equity swaps to reduce leverage in the system. Recalibrating state aid rules for a systemic crisis could well be very necessary, and many member state governments have been looking at that. And clearly we need to accelerate equity investment measures under the CMU project. We're very happy to see that already some of these recommendations are reflected in the actions of some EU member states. The French government recovery package announced 2 weeks ago includes a measure to support the provision of equity loans, a form of subordinated debt, to firms which were affected by the crisis but remain viable. In practice, the French government will guarantee up to 30% investments funds which would invest in such loans. Banks would provide the loans to firms and then will transfer these loans to the investment funds in which institutional investors will invest. In order to align all interests, banks will keep a minimum share of each loan, possibly up and probably up to 10%. And this measure will also apply to subordinated bonds. In order to mobilize, crowd in, if you will, equity, and in particular, probably private equity funds. Other member states are considering similar actions, and AFME and its members are very keen to continue to engage with governments and treasuries to provide a helpful market perspective. And indeed, we were actively consulted by the French Trésor, who were very interested in the report. The long-term objectives must be around capital markets union, and AFME very strongly welcomes and supports the CMU action plan. The challenge, of course, is to maintain the momentum and develop a fully fledged capital markets union. The COVID-19 crisis further demonstrates the urgency of this project, and urgency is the critical word. And we think that official institutions and member state governments will find very tight alignment. Policymakers and the financial industry need to move beyond bridge finance and liquidity in the form of debt to focus on critical long-term economic repair and recovery. And as noted, equity capitalization should be promoted for this purpose. AFME supports a number of priorities in the CMU action plan, and I would highlight the following. Promoting investment and re-equitization of Europe's economy, and this includes providing an appropriate treatment of long-term equity investments by institutional investors and ensuring the prudential framework is correctly calibrated so that banks, insurers continue to support market-making activities and other services that are critical and indeed fundamental to the functioning of capital markets. A review and simplification of listing rules, stock exchange listing rules, particularly for SMEs, should also be prioritized on the basis of careful analysis. And you've already seen the UK stock exchange move to try and accelerate that for exactly this reason. Enhancing efficiency and connectivity and competitiveness in the structure of securities markets. The forthcoming reviews of MiFID II provide that opportunity and will be fundamental to promote diverse, effective, efficient, well-regulated EU capital markets that support the needs of investors and all citizens, consumers. An integrated and competitive trading ecosystem is vital to support capital raising by companies, investor returns, and enhance the attractiveness of all the EU financial centres that are beginning to flourish. For EU capital markets to indeed flourish and thrive, it is vital to maintain and continue to develop trusted, fair, effective, open capital markets that are able to provide access to global capital pools and funding opportunities while ensuring market integrity and fair treatment between EU firms and third country entities. The upcoming prudential reforms, CRR3 in our jargon, impact banking union. At around the midpoint of this year, in June, the European Commission is likely to present its legislative package to finalise the implementation of Basel III into the EU CRR3. Considering the still evolving impact of the COVID crisis, it is more important than ever to fully understand the cumulative effect of the crisis and these reforms on the EU economy, and to uphold the international commitment to avoid significant increases in capital requirements. You heard in the first panel about the calibration of vaccine rollout, the health of the economy, and the interaction with bank provisioning and potential estimates around NPLs. And in this context, the completion of banking union remains a critical and key priority for a more stable European monetary union and to establish an integrated, competitive banking system in Europe. Another thought is around reinvigorating securitization markets. The promotion of well-functioning European securitization markets is also one of the key Capital Markets Union work streams. I very much agree with the words of Otmar Karas when he said in December 2020, when used properly, securitization becomes vital medicine for a stronger recovery after the COVID-19 pandemic. It creates new investment opportunities and more scope for banks to issue fresh loans to households and SMEs. I know we're going to have a really stimulating next panel. I know these points will be discussed. I'm particularly grateful to João Nuno Mendes, the Finance Minister for Portugal, under the Portuguese presidency of the European Union. A huge thank you, sir, for taking the time to be with us today with all our audience. Thank you to our audience. And I'd now very much like to welcome my colleague, Stefano, Managing Director of Advocacy at AFME, known to many of you, who is going to be moderating this panel event. Stefano, welcome. Wonderful to see you.
So thank you very much, Michael, for your remarks, which represent an excellent transition from the topics discussed earlier in the first panel to those we will discuss now in this new session. Indeed, finding an innovative solution to address the very significant equity gap that corporates will be facing in the near future is indeed a crucial priority. And as you have said, AFME will continue its work to support European policymakers in designing such innovative solutions. Good morning, everyone. My name is Stefano Mazzocchi. I'm Managing Director at AFME, and I will be the moderator for this second session. Today we have an outstanding panel on the road to recovery, what policies to ensure that businesses have access to finance, and what policies to strengthen financial markets' role in rebuilding the economy. So while earlier this morning, during the previous panel, we have mainly looked backwards, test the situation, the impact of the pandemic, the economic outlook, and some of the lessons learned. During this panel, we'll be taking a different perspective, more forward-looking, if you like, and we will be talking about the policy choices that are necessary to support the recovery. And we all know that in the coming months, important policy decisions will be on the table. So an extremely important topic indeed, and I think what I've just described as an objective for this panel is a very ambitious panel, but we have the privilege of having 4 excellent panelists, which will be able to bring different but complementary and very relevant perspective on these topics. So without any further ado, let's introduce the speakers quickly. The panel will start with some opening remarks from João Nuno Mendes. João is Secretary of State for Finance in the Ministry of Finance of Portugal. He has previously held other important positions in the Portuguese government, including Secretary of State for Planning and Economic Advisor to the Prime Minister. João has also held senior positions in the private sector, in the Grupo Amorim, in Galp Energia, and more recently as CEO of Grupo Águas de Portugal. Importantly, João is playing a central role, of course, in steering the activities of the Portuguese presidency of the Council of the EU during this semester. Before giving the floor to João for his opening remarks, I would like already now to introduce the other panelists. Martin Merlin is a director at DG FISMA, where he leads the directorate responsible for bank, insurance, and financial crime. Martin joined the Commission in 1997, and since then has held senior positions in various domains of financial services regulation. The third panelist is Veronica Ormezzano. She's head of Group Prudential Affairs at BNP Paribas. She's also chair of AFME's Prudential Regulatory Board, and Veronique has joined Paribas in 1994 and has held several senior positions, including global head of official institutions coverage, head of economic capital, head of loan portfolio management, head of financial information and investor relations, so a very distinguished career in the BNP Paribas group. The final guest, the final panelist will be Tarek Tranberg. He's head of public affairs and policy at the European Association of Corporate Treasurers, the EACT. Tarek leads the EACT public affairs and advocacy work. Therefore, he represents the interests of corporate treasurers from across the 23 member association of the EACT on all aspects of European financial regulation. So once again, I wish to thank all the panelists. It's now time to open the panel discussion, and João, thank you very much again. The floor is yours.
So thank you, Stefano, and thank you, Michael, for this invitation. So we thank AFME and Business Europe for this invitation and to participate in the panel on behalf of the Portuguese presidency of the European Union Council. So we are living challenging times. So we think that our main task in the presidency is to utilize all this effort for the recovery of the economy in Europe. We have extraordinary instruments put in place. We had a general escape clause fully working, and there is the expectation that it will work also in the coming year of 2022. We think that really the consensus, the coordination between the different institutions and the consensus between the different countries really made a difference from previous crises. So, and we think that this represented to the market very strong and positive expectation for the future. So we feel there's a strong consensus between the different member states because all the member states are being strongly affected by the crisis. Of course, we have within our economies the most affected sectors, and we have still challenges ahead in those sectors because there's some uncertainty about what's going to be the recovery for those most affected sectors, which are larger in certain economies. But regarding those very big instruments that are now in place, I will stress the role of the recovery plans, that we hope that most of the member states will have their plans submitted formally by April and March. And so that would mean that 3 months after, by June or July, we'll have those plans approved for most of the European Union countries. So there's a structural element on these plans. So they are, designed not for the liquidity purpose, because as it was already mentioned, we have been running and we are still in this liquidity support stage. But the recovery plan is prepared, to tackle structural weaknesses. So we have 37% in order for the European member states to have the capability to address the European Green Deal challenges, and we have 20% for the digital effort. So we think that there's this balanced approach between looking to the future, preparing ourselves, and strengthening our economies and their potential to growth, and this support to the liquidity. And we are still ongoing in that stage. So there's a strong consensus between the different institutions that we need to avoid cliff edge effect, but there is also this awareness, and I think that Michael referred to that we need to implement the transition measures like the hybrid instruments, recapitalization instruments, for which we have a number of challenges, as it was already mentioned specifically, how to address, how to implement such instruments in the most critical, most effective sectors in the economy. We think it's also an opportunity for us to, revitalize, capital markets and to promote the capital markets union. Let me tell you that in the coming ECOFIN in April, we'll have a presentation by the Commission about the results of the public consultation regarding the single access point that refers, to the European SMEs and how they can be structurally presented with financial and non-financial indicators to potential investors. So I think it would be a very interesting and powerful instrument to attract investors. We feel that the capital markets can act as a catalyst of entrepreneurship, because we have been seeing that the technological based entrepreneurship is a lot stimulated by the capital markets, because I don't have studies that can demonstrate it. We think that perhaps the way that the capital markets finance and the way the banking system finance, because of the regulatory requirements, is different in terms of the scale of risk that can be assumed. So we think it would be great for Europe to have capital markets more developed that can act as a catalyst for high risk but with high potential areas of our economy, mainly the technological based businesses. So the CMU is a focus for us. One of the things that were addressed is precisely the issues related to insolvency, NPL, and of course, when we look to the performance of the banking sector in the last decade, we can see that there is, of course, an increase of the capital ratios. So we feel that there is, better management models in place, and we feel that we are stronger to deal with this crisis. But of course, we understand that there is an expectation of the financial markets that will go ahead with banking union. So we think that it will be possible by the end of the first half of this year to have a roadmap for the banking union. Already having some breaches between the different positions that we have in the member states. So these were some starting remarks. Thank you.
Thank you very much, João, for these opening remarks. And I think you have outlined, a very comprehensive panoply of instruments that the European Union and member states have put on the table to respond to this crisis. And indeed, the Next Generation EU initiative will play a key role. I think it's another example of European integration being forged in crisis. This is, of course, an important test that all of us and the European institutions need to go through. I think another important message that you have conveyed very clearly, João, is a strong sense of urgency on the need to make progress on the many fronts and initiatives that you have mentioned, and I think that's a very important message. So let's turn now to our panelists for a first round of comments, which I'm sure will touch upon the important points highlighted by João. I would suggest that in this first round, panelists remain within the 4 or 5 minutes. Unfortunately, we don't have much time available. And then after this first round, we will then take, if possible, maybe some questions from the audience. So Great. Let's start with Martin. Martin, I think you agree on the point about the need to make progress urgently in several areas, and I think it must be said that the European Commission has been very quick and effective in responding to the initial phase of the pandemic. The pandemic has clearly opened a window of opportunity to do things which would have been extremely difficult only a few months ago. Martin, is that window already closing now? And from your perspective as European policymaker, what is necessary and urgent to achieve in the coming months and years, in particular to ensure that financial markets and banks in particular can continue to support the recovery? Martin, the floor is yours.
Thank you, Stefano. It's a very broad question for only 4 minutes, so I'll really focus on what is essential. I think in this debate about recovery and the re-equitization of Europe's economy, we have to distinguish between the short term and the long term. What can be done in the short term? Well, we should see if new types of instruments, hybrid instruments, can be developed and accepted under our state aid rules. It was noted very recently the European Commission gave its blessing to an interesting scheme developed in France, and you can be sure that the Commission will be very reactive in studying other schemes that may be useful to support the re-equitization that we very much need in order to plug the equity gap as much as possible and reduce the debt overhang. I think in the short term as well, we have to make sure that we calibrate our prudential rules wisely without compromising at all as regards financial stability and the prudential soundness of our banks. But we have to make sure that we do not penalize our financial institutions with prudential rules that may make it even more difficult for those institutions to invest into the European economy through equity. This is important for banks, of course, with the pending introduction of Basel III. And here I think it will be particularly important to make sure that we do not confuse long-term strategic equity holdings with speculative investments. There is a certain degree of ambiguity perhaps in the Basel standards in this respect, and we have to make sure that the two are distinguished. That's one example. Banks are important, but insurance companies are important as well. As you know, we plan to table a review of Solvency II later in the year. We've done a number of things already in the past to make it easier for insurance companies to invest into equity. EIOPA has made a few proposals to go a little bit further and introduce more flexibility so that insurance companies can invest more into long-term equity that they hold. And we will be looking at these suggestions from EIOPA with interest. And then, of course, there is the long term. And in the long term, the main show in town is surely the Capital Markets Union project. We've always made it clear that this is a long-term project. It still is, but we hope that there will be a greater sense of urgency in the member states and in the parliament in order to make significant progress on that front. And as you know, investing more into equity is one of the cornerstones of CMU. And I'm not going to list all the measures that seek to achieve this aim, but this is very much one of the core objectives of CMU. So we hope very much that under this legislature, of the Parliament, under this Commission, there will be a big push to make CMU more of a reality. I should also say that, we'll need time to achieve a number of things, but what we plan for the long term can also have positive knock-on effects on the short term. If we introduce the right signals, be it in prudential legislation or by advancing the CMU project, I think it will be conducive to greater confidence among market participants that Europe is indeed setting up a place where it is easier and safer to invest into equity in the long term. I cannot finish without saying a word about Next Generation EU, which, as was rightly said, is there to address structural challenges. And if we are to have, speedy and sustainable recovery, it is absolutely essential that the member states use the recovery facility in order to really boost productivity and innovation. That is going to be absolutely critical for Europe's future. I'll stop here.
Thank you very much, Martin, for these comments and also for managing 4 or 5 minutes really to give a very rich and comprehensive picture. Let's now move to the private sector, banks and corporates. Let's start with Veronique. Veronique, the policy and legislative agenda for the coming months will be particularly intensive in the coming months, and indeed Martin has given us, a sense of what is coming up. In your view, what are the opportunities, but also the risks, the potential pitfalls that you see in the coming months and years in terms of this upcoming legislative agenda?
Good morning, and thank you very much for having me in this panel. When I was asked to talk about the road to recovery, I figured I might want to address this very complex topic by 2 approaches, the do's and the don'ts. So let me start with the do's and then move to the don'ts. And before that, I cannot, of course, avoid thanking all the, I would say, public responses, whether coming from national authorities, from the Commission, from the ECB, of course, on the monetary side, that really helped the banks to continue to help their clients. And we really worked hand in hand with our clients since the beginning of this crisis. And I cannot also avoid mentioning that in France, where I sit, just yesterday, another 4 weeks of confinement was decided in a large part of France, and of course our teams at BNP Paribas are back talking to the clients in the sectors that will be affected, and we are quite committed to continue to support the economy, including in the sectors that are suffering the most on those lockdown periods. So. But overall, this response to the crisis has worked really well, and I think to a large extent Europe has learned the lessons of the 2008 crisis and Eurozone crisis and made really very bold steps to avoid the same mistakes, and this is really to be welcomed. Of course, the crisis is not over, and so we will need as banks to continue to support our clients, including by providing more equity or quasi-equity support. Martin mentioned the French program that on which the Commission has provided its support, I understand, and which is going to be launched at the beginning of April. This is exactly in line with the recommendations of the AFME report, because the same diagnosis led to the same solutions, I guess. And we also share the view that we need to provide solvency support to viable companies, of course, not to zombie companies, but to companies that have a business plan and that are there to create jobs and create growth for the future, to help them finance invest in the recovery. In a nutshell, the way it will work is that banks will propose to their wide network of clients a participating loan with a maturity of 8 years, with 4 years of deferral of reimbursement. So this provides really a good period for corporates to absorb the cost of the crisis and restart building their cash flows and their market share before starting to reimburse. This is the big difference with, I would say, the state guaranteed loans and any other traditional loan. That is making this product more hybrid. There will be strict eligibility criteria as a function of ratings, because again, this is not about financing zombie companies. This is really to support the future growth of Europe. As I said, it will be backed on a solid business plan. The banks will keep 10% of these loans on their balance sheets and transfer 90% of those loans to a fund, which will benefit from a guarantee from the government up to 30% first loss. These funds will be open to private sector investors, so this is really a combination, if I may say, of the capacity of the banks to target a wide number of companies thanks to their network, and also the capacity of the capital markets, as was said by Joao, that is better placed to provide quasi-equity type of risks, because clearly banks have a very high regulatory treatment for this kind of product. So it is too early to say whether the product will be well received by borrowers and by investors, but we strongly believe that this is a kind of initiative that can help boost confidence in the corporate sector for further investment, and this is really what we need. And so stay tuned, and if anybody in the call wants to invest in the fund, just call me, because this is really, I think, a good opportunity. So that's about the do's. On the don'ts, I think while all these responses have clearly been a success, when we look at the low level of default rates across Europe compared to what could have happened, as Edouard said in the previous panel, we should not be complacent, and we should really avoid the cliff effect of any exit from the crisis. We have to say that in many cases the measures that have been taken in Europe are actually a little bit halfway compared to the measures that were guided by the Basel Committee or implemented in other jurisdictions. So unfortunately, we are at this stage, and I think it was Eric from UniCredit who mentioning this in the previous panel, the competitiveness both of the financial sector and of Europe as an investable set of securities, if you like, has unfortunately receded, because we are the continent where the growth prospects are the lowest, and the benefits in terms of regulatory flexibility is certainly a lot less than what the US banks are benefiting. So we are facing actually two kind of competitiveness issues to restore profitability. One is on the CIB side with US banks that are continuing to grow their market share, and one on the retail side on the so-called overbanking. And among the don'ts, I would cite the need to avoid, as part of the crisis management process and the banking union implementation, any measure that would go against the need for the restructuring of the banking sector to reduce this overbanking situation. And we are a little bit worried about that. On the exit, back to the corporate sector, the exit of moratoria and state-guaranteed loans, of course, is a key subject that we will have to manage on a case-by-case basis, because each corporate is different. We are well equipped to analyze those risks, but the key point is that we should not be forced either by too procyclical regulation or classifications like the calendar provisioning, these kind of things, or by too rigid supervisory scrutiny to classify viable companies as NPLs first, or to over-provision beyond what we believe is needed due to a lack of, I would say, comply or explain approach and flexibility by the supervisor. So that is, I think, a risk that is very very important to manage. Marta mentioned the Basel Accord. Of course, it's quite important to avoid any unnecessary, I would say, regulatory pressure. This is about Basel. It's also about the way the stress test will be performed and communicated to the market. We are in the middle of the 2021 stress test exercise. Questions such as, can the buffers be usable, are quite key. They are key in the real life, and we are grateful that the decision was made early on in the crisis to make them usable up until 2022. But we wonder why, in this case, they should not be considered as usable as well in the stress test scenario. So there is a need to be really consistent across the various regulatory and supervisory exercises to make sure that the banks do not get the wrong incentive or conflicting incentives between supporting the economy, which obviously we are totally committed to do, and at the same time having more and more scrutiny on risk management, provisioning, classification, which is good if it is judgmental, but may go too far if it is too rigid and rule-based, whereas the real situation is really a case by case. And then I would finish with ESG. We haven't talked much about climate since this morning, and it's probably the first panel I'm participating in the last 6 months where climate is not at the core of the agenda. So let me say a couple of words. So we need to finance the recovery, and we need to finance the long-term transition-driven investments. So it is critical that the taxonomy, which is very well targeted to define what is green, i.e. what is actually a science-based target towards the Paris Agreement achievement, is complemented by a dimension of transitioning. This is so far not yet the case. We very much welcome the request that the Commission has issued recently to the platform to better take into account the transition. This is absolutely critical for the recovery, both for the private sector to invest, not only banks but also asset management, but of course also for the recovery programs at European and national levels to target the funds toward the transition, and not only toward the green part, which remains a very small proportion. So we have shared some proposals on this, focusing more on trajectory, on transition pathways based on commitments to align on the Paris Accord, and we hope that the Commission will really substantially increase this transition dimension in its delegated act, because this is absolutely crucial. I will stop there. Of course, I could go much further, but that's, I think, the key points. Thank you.
Thank you very much, Veronique, for these comments. Let's turn now to Tarek. Tarek, you represent the corporates, and in particular, the EACT represents the corporate treasurers who are in a crucial position in securing funding, in managing cash flows, and also importantly in managing risks. From your perspective, which are the key challenges that corporates face in the current environment?
Thank you, Stefano, and thank you to AFME and Business Europe for putting the event together and for inviting me to speak. So I think maybe if I cast a few seconds of a sort of backward look to last year and just highlight that I think the corporate sector has in many ways faced, I think, a number of concurrent challenges. I mean, obviously the pandemic is one of those. For many corporates, 2020 was about survival, ensuring critical liquidity and cash flows at the right times. There is also the bigger question about the long-term shift to sustainability, which has been an important factor for many corporates. But then for Treasury specifically, there's been also bread and butter issues like LIBOR transition, which is coming up towards the end of this year, which has taken up significant resources in many corporates over the last year and will continue to do so leading up to the end of this year. I think broadly speaking, 2020 has been manageable for the corporate sector, largely because of public sector intervention and because of the support schemes that have been put in place, and because a lot of corporates have drawn down existing debt facilities and credit facilities that they had with the banking sector. This means that the risk now becomes that as this public sector support is unwound, many companies would probably only have recourse to either prohibitively priced equity financing or prohibitively priced debt financing. And the question would even be whether a wide spectrum of corporates, even if they could, would actually be able to access the debt liquidity that is on offer. The reason for that is that because of the massive increase in debt financing over the last year, a lot of balance sheet structures of corporates mean that they would probably face significant increases in interest payments, so that even if they could access debt financing, they probably would not choose to do so at this point in time. This then means that by necessity, we need to find some other way of recapitalizing at least a large segment of the corporate sector. And I think the study commissioned by AFME is very helpful in this regard, because it raises some interesting thoughts about potential recapitalization solutions that could be used to support the recovery of businesses that are otherwise viable. I think that's an important point to make. And I think there's a European-wide hybrid financing instrument is an interesting concept. I think there are some national schemes that exist that are quite attractive and that would be interesting to see if they could be replicated in some form at European level. I think there are some, for example, some profit participation schemes or profit participation instruments at national level. I know that this exists in Germany and Austria, for example. But I think looking ahead, the question on having a European hybrid instrument will probably also raise some existing questions in the context of CMU around harmonization of insolvency laws, bringing down barriers to cross-border investments, the withholding tax treatment of cross-border investments, and all of these issues that have been on the CMU agenda for a number of years now. I think crucially those will need to be solved in the long term if that's going to become if a hybrid instrument at European level were to become a viable solution or a viable option moving forward. I think in the broader context of CMU, it could also be interesting to look at potentially lowering the listing burdens and listing requirements for smaller companies. I think that in a drive towards integration and creation of CMU and moving companies towards more market-based financing and away from purely bank-based lending, I think that's an important thing to consider. And supporting that, you could also consider, I know that some things were done last year already on the prospectus front for already listed companies to simplify secondary issuance. One could also consider that for those companies whose balance sheets after last year are still solid enough to take on additional debt without excessive leverage, that one could also consider lowering the burden for the debt prospectus, at least for a short period of time, for otherwise viable companies to take on additional debt. But I think, broadly speaking, in the short term, my concern is that bank lending will remain key. There's not going to be an overnight shift to market-based financing and listing. So I think looking ahead to the regulatory agenda, it'll be important for European corporates that when it comes to the implementation of things like Basel III, for example, the EU preserves some of the specificities that exist in the current framework for the treatment of corporate exposures on bank balance sheets. And this is relevant for the pricing of hedging instruments, specialized lending facilities, credit facilities, supply chain finance, trade finance, and so on. I think it's quite important that some of the specificities in this regard are maintained so that prohibitive pricing is not passed through as a result of higher capital charges for banks to a corporate sector that is already struggling quite heavily with managing just the current climate of economic uncertainty. I think overall, corporates like predictable and balanced policy frameworks. And in that sense, that's sort of the important thing to bear in mind moving forward, that everything needs to be in a sort of a balanced approach that sort of carefully weighs risks and opportunities. And on the more long-term horizon, I think there's a concern about further moves towards any type of standardization of corporate bond markets. I think the attractiveness of bond markets for corporates is the fact that they are customizable to serve specific needs of companies. So I think any moves towards standardization in that sense are something that would not necessarily help at this stage in the recovery. And I mean, Veronique mentioned sustainability. I think there is a concern that in the current uncertain climate and companies trying to manage sort of the impact of the pandemic and moving towards recovery, at the same time doing some sort of that might seem mundane issues like LIBOR transition, that's additional disclosure requirements being brought in too quickly and too comprehensively might be difficult to manage for at least smaller companies, especially when these things are being brought in at short notice with details not being sort of clear until a couple of months before the disclosure requirements are being phased in under the taxonomy regulation. So that's just a broad tour through some of the issues that are relevant. I think CMU is critical, and maintaining bank lending in a way that is helpful is also critical. I'm sorry if I went over a little bit.
No, thank you. Thank you. I think it was a very interesting remarks. Of course, we are indeed a bit behind in terms of our schedule, so we do not have time for a proper second round. But maybe what we can do is to go back to each one of you for a minute, for a few seconds, just to to react to what the other panelists have said before we wrap up the panel. Maybe we can start with João. João, any kind of final thoughts from you?
Well, thank you, Stefano. Maybe a couple of comments about Basel III, which was mentioned before by some colleagues of the panel and also by Michael. Just to say that it's quite important to reduce the variability of capital requirements and increase the comparability of the capital ratios, and also to fine-tune several areas of the framework. So I think this is one of the main objectives, and the capital needs are significant, but a very recent update of European Banking Authority showed that there is a decline of debt estimation. Having said that, we recognize that we are living a very challenging moment, and the capital increases may be quite challenging for the moment, and so we think that there will be plenty of time for the discussions to be held at the level of the Council and also with the European Parliament. So we think that a final reasonable approach will be achieved. So the review will be presented on the Capital Requirements Regulation Directive will be presented by the European Commission. So I think that there will be a reasonable approach, also considering the challenging times that we are living. We feel, as regards this idea of the hybrid instruments and its connection eventually with CMU should be something that we, at the level of the EU, with the support of the Commission, to give further steps. Also, because there is a lack of. We also have understand that from different member states, the need for us to have, I would not say standard action, but we have a common approach vis-a-vis the most affected sectors. So we feel that the support of the Commission, just for us to see how we can develop this hybrid model in a way that's effective, and we can take forward, the most successful approaches. That's going to be key. Thank you.
Thank you very much, João. Martin, any final comments or reactions to this discussion from you?
Yes, thank you, Stefano. Well, to conclude, I can only reiterate the Commission's commitment to really focus on promoting a resilient and sustainable recovery. The financial sector will have a major role to play in this regard, to build a greener, more digital, more inclusive future. And therefore, financial regulation needs to be looked at with great care to make sure that it also helps in achieving these objectives. At the same time, we should not, place too much responsibility on financial and prudential regulation. It is not the only show in town, and we have to continue making sure that the prudential regulatory framework serves its first purpose, namely to maintain financial stability and the protection of investors and deposit holders. So we have to make sure that we get the trade-offs right. I think it would be, and I will finish with that, it would be really extremely beneficial if we could see in the Council in particular, and I know we can count on the Portuguese presidency to do everything to achieve that, if we could really see, greater momentum behind CMU and banking union in comparison to what we've seen in the past. If we can make progress on EDIS, the hybrid model in particular, if we can make progress as well on banking market integration to make life easier for large banks, and make sure that we tackle overcapacity in the banking system. If we can see some decisive agreements on capital markets union items, I think that would be excellent for, confidence in general, and that would help us getting on a sustainable recovery path. We can, of course, understand that over the last year, political attention was focused on other issues, and very rightly so. We hope now that political attention at the highest level will come back to these topics with really a willingness among member states to make progress. And I know that in the Parliament they are eagerly waiting for that and ready to act fast on their side as well.
Thank you very much, Martin. I think a very important message from you on the need to send signals to market participants about the fact that the long-term priorities are there, and there is momentum behind them, and this will have effects also in the short term. Veronique, any quick final thoughts from you?
Yeah, thank you very much. Just echoing Martin's point, I can only confirm that this CMU and banking union project are absolutely crucial to support the recovery. I would say that on the CMU side, this is obviously a long-term project, in particular things like insolvency laws or these kind of things. There are also some low-hanging fruits, and we should keep them in mind because they may be extremely helpful. And I'm thinking in particular about securitization. This hasn't been mentioned yet, but it is a very important way to bridge, I would say, the banking lending part into the capital markets. And I think this is very important. Also, commercial paper is a very important source of financing for the corporate sector. And we see that all this framework around various types of securitization is essential, not just NPL securitization, which is, I would say, the emerged part of the iceberg currently, but really we need a holistic review of securitization to make it work and grow the market, which is very underdeveloped compared to the United States in particular. On banking union, I would just say a word which is I'm sometimes a bit worried that the discussions is focusing on one side of the banking union, which is the constraints or the costs, I would say. So EDIS, which will be a cost for the banks and so on and so forth, and not enough to the benefits. And the benefits is really banking integration. This means all the debate about waiver and so on and so forth. And on that part, I can only echo Martin's comments that we would really hope that among the council, and maybe leveraging on the momentum on further integration more broadly around vaccine and recovery plans and so on, maybe there is also, and also around European sovereignty issues, maybe there can be some momentum to change this mindset of home host debate, which has been really polluting, I would say, the discussion on the creation of an integrated banking sector in the last few years since the euro crisis. And finally, I would finish with Basel, because this is obviously maybe very the most impactful regulatory piece that we have on our plate this year and beyond. I would warn against maybe a too superficial reading of the EBA report. The way the EBA is calculating the shortfall, which is indeed reducing, is actually, I would say, very minimal. It is what it is. It is very explicit in the report, but maybe not everybody understands what it means. The way that EBA measures the shortfall is actually assuming that banks can run at the level of their minimum distributable amount. Because only the shortfall when banks go below their MDA threshold is taken into account in the calculation of the shortfall. And this is quite problematic because the distance to MDA is one of the most important factors for financial stability that is looked at by the market. So I think, unfortunately, we don't have any better figure, but I would warn that the policymakers, I would say, take as granted the fact that Basel can be easily digested based on those figures. And I will stop there. Thank you very much.
Thank you very much, Veronique. Tarek, 30 seconds reaction from you.
I'll keep it short, no worries at all. No, I think I'll just reiterate basically what has been said. I think that it's important to balance in the short term and in the long term, preserving banks' ability to sort of lend to the economy, and also the sort of flip side of that coin, to preserve corporates' ability to manage their commercial risks while still enabling their commercial activities. But then in the long term, really pushing forward CMU in a way that can bring more companies into market-based financing without a complete exclusion of bank lending from the ecosystem. I think both sides have an important role to play, and maybe CMU needs to have more of an emphasis, but I think it's important to preserve both the bank lending side to the economy and incentivizing more companies into public markets. That's the critical balance to strike.
Thank you. Thank you very much, Tarek. We have now reached the conclusion of this panel and of this event. I would like to thank all the panelists for these very rich discussions. I would also like to thank the audience for their participation, and I'm sure that the audience is now joining me in a virtual applause for our panelists. Also, many thanks to Business Europe and to James and Eric in particular for a fantastic cooperation. And last but not least, I wish to thank my colleagues, Anna, Claire, James, Dave, without whom this event would have been impossible. So many thanks again, and I hope we will be able to resume the discussions on these important topics in person in the near future. Have a lovely weekend, stay safe and healthy, and see you soon. Thank you very much.